So, why do people, particularly high income earners, put their money into whole life policies, especially when we're talking about infinite banking? Well, because whole life is a safe, liquid asset with reliable compound interest that's protected from the tax man, right? It's a tax shelter. We could go so far to say it's the original tax shelter because whole life existed before the US tax code. So, why is it safe and reliable? Well, because the underlying assets of a whole life policy are fixed income assets like treasury bonds, which yield us safe, consistent cash flow. Meanwhile, your bank doesn't always do that. Remember, when you put your money in a bank, that money becomes the bank's liability. So they go out either through fractional reserve banking and lend out 10 to 1, or they give it to their trading desk and they make millions while sharing with you practically nothing. Barely peanuts worth. Conversely, whole life carriers are cooperatives. You're part owner with them, sharing in the profits of the company via dividends. With a traditional bank, you're just a creditor helping CEOs like Jamie Dimon get a bigger bonus.
We should be focusing on and not.
Why don't you run for office?
I'm not suited for office.
Why?
And by the way,
Why aren't you suited for office?
because I'm not. Look at me.
So, what about that tax shelter component? Well, IRS laws designate the compound interest growth effect in the death benefit value as well as the cash value of a whole life policy to accrue tax free. Why? Well, because the cash value portion of the whole life contract is technically the net present value of that future death benefit payout. So, because the cash value is a fundamental component to the contract's tax free death benefit, the cash value is protected and has qualities of a tax shelter, which means the growth of the cash value is protected and tax free. Think about this. Everyone out there is looking for some kind of yield on their money while preserving capital. Go look on YouTube, you'll see endless videos on real estate investing, dividend investing, some random high APY savings account, peer to peer lending websites. Just about all those have the same two problems. Your capital is open to risk, and your yield is taxable. In the hunt for yield, most investors end up taking on riskier and riskier investments to find that yield, which may come back to bite them. And as a side note, as a real estate investor myself, if I had a nickel for every time a tenant broke a dishwasher or a pipe freezing in the winter, chewing up my total annual return, I'd be taking it easy in the Caribbean by now. And on the subject of taxes, the wealthy know this all too well, because depending on which tax bracket you're in, it greatly affects your actual effective return. If I can get tax-free 5% growth in my whole life policy, assuming I'm in a high tax bracket, I have to make close to 8 to 9% to get that same effective return in an outside taxable account. And based on the out-of-control deficit spending of the federal government and the ballooning national debt, eventually tax rates will have to go up, making the problem even worse. And let's not forget, distributions from whole life policy are tax-free via policy loans. Now, this is crucial to understand. Consider the classic infinite banking cash value accumulation chart versus a traditional bank account. When I take a loan against my cash value is collateral for that loan with the insurance carrier. Therefore, they can continue growing compound interest on my initial total cash value. You can't do that with a traditional bank account. In a bank account, as we all know, savings or checkings, once the money leaves, you pay that opportunity cost and your account value decreases by that amount. The loans against our cash value and are still compounding in the background. This means that every time we take a policy loan and pay it back, we realize a new potential which may be tens, if not hundreds of thousands more than what we started with. We're always growing our available capital, ready to take on the next, newer, bigger opportunity. And don't forget, you can take up to 95% of your total cash value as a loan and hold those loans out as long as you want to. We don't even have to pay principal and interest for years if we don't want to. We just call the carrier, we fill out a form, and our funds are wired on over. No underwriting, no credit pulls, no 2-month waiting period for approval. Try that with a mortgage, refinance, or a HELOC. So we can see why the whole life cash value is a big deal for capital preservation, appreciation, and overall liquidity. The next question is where to go and which carrier to work with. Well, today we're going to be looking at arguably one of the best whole life carriers in the space for maximum immediate cash value and appreciation, Penn Mutual. Penn Mutual has a new and improved accumulation whole life product that's frankly impressed me so much, I'll likely be putting together my second permanent life policy with them. And unlike many fly-by-night agents out there, we're going to be focusing on how to put together a maximized design policy for cash value and show you the difference between a good design and a junk design. A lot of agents out there are going to hate on me for this because they're too busy distracting their clients from policies that would be considerably more beneficial for their client. I've seen this happen way too many times in this industry, so instead, we're going to peel back the curtains and show you what goes into creating the perfect high cash value policy. So hold on tight because we're going to be diving into product design and considerations to maximize our cash value for our own personal infinite bank. So let's get started. Welcome to the channel. My name is Joseph Gutierrez, and this is Covered in Compounding. Subscribe to the channel to learn more about why we call cash value life insurance as the foundational asset to build our portfolio and provide the tax-free nest egg that we're looking for. In choosing a whole life carrier, we should take note of a few important details. Number one, the health of the company, namely the length of time the carrier's been in business and their ratings and scoring feedback. Number two, the policy's returns. Their gross dividend yield and internal rate of return on cash value are important. Number three, are they a direct recognition or a non-direct recognition carrier on policy loans? And lastly, the type of term and PUA riders that they have and the rider's flexibility with contributions. This is very important, especially for infinite banking. Okay, so Penn Mutual was founded in 1847, meaning they have a track record of solid dividends and stability over 175 years. They have a Comdex score of 93 out of 100 with A+ ratings from AM Best and Standard & Poor rating agencies. So Penn Mutual's business has stood the test of time and has rewarded its policy owners accordingly. Penn Mutual also has one of the higher dividend rates in the industry, standing at about 6% gross dividend yield in 2025. We pay attention to dividend yield because it indirectly tells us the overall health and growth of the carrier's general account and their decision making as a carrier. Its current internal rates of return hover around 5% at the 30-year mark, depending on a number of factors. We pay attention to IRR on cash value because it makes a profound effect in the growth of the policy over the long run. Penn Mutual is also a direct recognition carrier on policy loans. So direct versus non-direct recognition pertains to how the insurance carrier applies the dividend on amounts of cash value they have policy loans out against them. Direct recognition means they adjust the dividend generally, but not always, downward on the loan amount. At first glance, this may not seem so great because we're growing a little less when we borrow, but on closer inspection, when compared to non-direct recognition carriers, we see that our loan interest rate is considerably lower, saving us a lot of money when we do borrow. I can think of one other well-known whole life insurance company that has a non-direct recognition component to their policies, meaning they have the same dividend whether you borrow or not, but their dividend rate sits at 5.3% with a loan rate of 7%. Meanwhile, Penn Mutual has a 6% dividend yield on non-borrowed amounts and a 4.65% dividend on borrowed amounts, at least in 2025. That said, the loan interest rate is only 5.3%, saving us 170 basis points on borrowing costs. That's a lot. Penn Mutual also has this clever thing with a policy in years 11 plus. It gets an increased dividend of 5.3% on borrowed amounts. So our loan rate and our dividend rate are the same on the borrowed amounts. Generally speaking, direct recognition is preferred because it doesn't penalize the other policyholders and enhances the stability of the carrier's general account. This indirectly allows the carrier to produce a stronger dividend and a lowering borrowing rates. That said, over the long run, the difference between the two different types aren't terribly significant, but it should be known to the client. Last one is the flexibility with the term and PUA riders. As a quick refresher, we incorporate a term rider, whether ART term or level term, to push up the total death benefit and lower our base cost in the policy. It keeps our MEC limits high so we can contribute more of our premium towards paid up additions. Paid up additions contribute almost 1-to-1 towards cash value. So for example, if we contribute $10,000 towards paid up additions, then my cash value will increase by approximately $10,000 as well. PUAs are added permanently to the base of the whole life policy, enhancing the total dividend that we receive, further heightening our compound interest effect on cash value. So if we're doing infinite banking correctly, then we want a vast majority of our premium dollars going towards PUAs, preferably up to our 7-pay MEC limits, and not towards the base. And we'll see this shortly. Penn Mutual has a clever rider called the Flexible Protection Rider that blends internal ART and paid up additions in one premium payment. That premium gets divided up to maximize cash value and reduce that required term. So the best way to think about it is picture a glass of water. If the glass is empty, we have all this space to pour water. As we pour water, the empty space of the glass decreases. Eventually, we get to the top of the glass, and there's no more empty space to add water. In this analogy, the glass is a total term amount. The empty space is the remaining term amount left, and the water is the amount of term insurance that has been fully converted to fully paid up whole life insurance. Those paid up additions directly add to the cash value of the policy and death benefit amount. And we'll see this in the design portion of our video. Penn Mutual also has two different paid up additions riders. One's called the Accelerated Permanent Paid Up Additions, and the other is the Enhanced Permanent Paid Up Additions. Both add to the cash value. The major difference is that the APPUA converts more of that term rider to PUAs. Think about adding more water to the glass. While EPPUA adds paid up additions to the base outside of what's going on inside that flexible premium rider, term rider. So the APPUA is a little bit better for shorter term funding durations, burning off that term and rider faster, while the EPPUA is better for longer term and absolute max funding. So we'll see the difference here in the example portion in part of our video. Now for the flexibility component. Traditional whole life carriers are not flexible with their PUAs usually. Luckily, this isn't the issue with Penn Mutual though. So we have a few extra flexibility options. One of the flexibility options is the riders that Penn Mutual allows us to catch up in the 3+ year mark of the policy if we underfund the PUA in the previous year. We could also make additional unscheduled PUA payments on a monthly anniversary dates instead of waiting the entire year. More importantly, though, is this line item right here in the illustration. If we'd like, we can fund our policy at a lower amount than our upper limit or even our initially planned PUA contribution without penalty, as long as we hit our lower limits of the cumulative required premium over 5 years. Our PUA rider doesn't change. This means that we can set up our policy to routinely increase our contributions towards our cash value growth as we grow in our career and income. This is a pretty big deal because most whole life carriers, if you don't hit your planned premium amounts, they'll lower your limits or get rid of them completely, reducing your ability to max fund your policy, as well as restrict your policy's growth potential for the long run. I can't tell you how big of a deal this is for a whole life carrier. They're essentially letting policyholders grow into their policy without additional underwriting. This is very unique in the whole life sphere. So now that we got the key considerations out of the way, let's get to the most important section, Penn Mutual policy design, and what makes a good policy for infinite banking and what makes a not so good policy. Okay, so now in this part of our video here, we're going to be looking at the different policy designs from a bad policy design all the way to a maximized design for infinite banking with our Penn Mutual carrier here. Okay, so one of the first things right off the bat is that when we're putting together a policy with one of our carriers, we don't necessarily focus too much on the death benefits, kind of more of a secondary or tertiary thing. We focus more in on what are the contributions, planned contributions, the flexibility the client's looking for, as well as basic financial underwriting. Okay, and then the death benefit is kind of like a side item, okay, any liabilities that the client wants to cover. That said, for the purposes of today's video, it's important to kind of keep that death benefit stationary to some extent and consistent to compare the different types of policy designs. Okay, so just know that if you sit down with us, we'll be focusing on different aspects. But for the purposes of today's video and to kind of illustrate the differences, we're going to be going over a policy for a 40-year-old male in near perfect health here and is looking for a total death benefit of $600,000. Okay, so in this first basic policy ledger that we see here, this particular policy is 100% base design. And we can see this quite clearly because all of our premium is going towards the base contract premium requirement. In this case, for this 40-year-old male, it requires about $10,000, so $10,110 to put into their policy to support that $600,000 permanent whole life contract. Right off the bat, we notice something here is that there's no cash value the first year, and that's your first and biggest tell whether a policy is designed appropriately. This is the kind of policy that we kind of see a lot of neighborhood agents giving their clients, which is a basically no paid up additions riders, no use of any term riders. It's just all going to the base. Now, why would an agent want to put this kind of policy together, especially if it doesn't help their client particularly that much? Well, because it has to do with their target premium. Okay, so the target premium is basically a measurement that the insurance carrier puts out that forecasts the amount of commission that agent makes. So for this particular base contract premium, the target premium is $10,554. So over the course of that year, the agent expects to make somewhere on the order close to $10,554. So one thing to know is that a lot of agents will kind of put themselves before their clients because they get a bigger commission check. The commission check is based on the base of the contract. Okay, so the few red flags you should look out for is what's that target premium and how much cash value is in the policy in the first few years and considering going forward. Now, one thing to keep in mind is that although this is not a good policy for infinite banking, it's actually not that bad of a policy in terms of break even. So for break even, we break even about our 11th year. So when we say break even, we mean when does the cumulative premium that goes into the policy show up as available cash value? And that takes place in the 11th year, which is actually not too bad. Most other carriers see 13, 15, 17 years. It just goes to show that the costs associated with the cost of coverage as well as the growth in the policy with Penn Mutual is exceptional, which allows them to, even on a bad design, have a pretty good break-even point. But all that said, for the purposes of infinite banking, this is a no-go. We don't want this kind of policy. Moving on to our next policy design here is where we incorporate the flexible protection rider. Okay, so remember that flexible premium rider incorporates the ART term, the annual renewable term, and paid up additions as well. Okay, so we can see that right off the bat here that we're paying about $2,256 towards this FPR rider. And we notice that our base costs are way less. Why is that? Well, we can do a base to FPR of basically for every one base, we can do 2x on the FPR rider. So in this case, for a $600,000 total death benefit, we only need 200,000 base, and we can have 400,000 allocated towards that rider, the FPR rider, which is quite nice. And part of the reason why our base costs are about a third less, or about a third of the 100% base, which makes sense. The FPR rider is also significantly less, so our total contractual premium requirement is $5,626. we notice that of that $2,200, roughly about $1,829 shows up in cash value. Okay, so remember, the FPR rider is made up of paying for that ART term, and the rest goes towards paid up additions. Okay, so those paid up additions, they have a load fee and things like that. So about 95% of it shows up as the cash value. So we can basically assume that the ART term for this particular client, this risk class, age, everything, is probably around $200 to $300, and the rest is going towards that cash value. The other thing we take notice of is when does it break even? And once again, we break even in our 11th year. Okay. Which, again, is not too bad, but at the same time, not quite maximally efficient, although the contract is considerably less expensive, it's about half the price. We also notice one thing that's quite interesting is that our total death benefit without the dividend is sitting around $600,000, and it's not increasing like in that 100% base design where it increased from day one. Why? Well, because we're filling that glass of water, right? We're increasing the paid up additions towards the FPR rider. And until we break even, we burn off all that extra term insurance, our base, at least without the dividend, will sit at about $600,000. And when does that burn off take place? Well, if we look at kind of the next page, we see right here in year 32 of the contract, we see where our total cash value equals just shy of 400,000, and we start seeing our death benefit increase here as we go through life. Okay, so this particular example is a little bit closer to what I would put together for an infinite banking concept type of policy. Okay, the positives here are is that the required premium is quite less than 100% base design, so it's better in that respect. We are getting, if we go back, we are getting more total cash value, but we're also not really maximizing the amount of premium we can put in. We have kind of a high death benefit for the amount of total cash value that's accumulating. That said, this isn't too bad for just someone looking for a decent amount of death benefit without paying an arm and leg for it. This is pretty good, but for infinite banking, still not quite. Okay, so now we're looking at our basic policy ledger where we're now incorporating one of the PUA riders. So we have a few things going on. We have our base right here. We have the FPR rider, and then we have the APPUA rider. So that's the accelerated permanent paid up additions. Okay, so just like before with just the FPR rider, we have a smaller base requirement. We have our FPR rider premium cost, and now we have the APPUA premium. And we made this for a total of the same amount that we're putting towards the initial 100% base design. Okay. So that said, we're going to see how this performs over the long run. Now, when we look at this policy here, we notice in our first year we're putting in $10,000, $10,110 of total premium towards our policy. Our total cash value is about $6,000 plus available in the first year. We continue on, and we'll notice that basically in our 8th year, will be our break-even point. Okay, so where our cumulative premium that's put into the policy is less than the amount of total cash value. In this case, it'd be $83,300 some odd dollars. Okay, at least on an anticipated measure. Also, another thing that we notice is that if we go down to our 17th year, we have this little 1 next to the 17, which designates this is when the FPR rider, FPR rider is extinguished, right? So we've filled up the glass, if you will. We've replaced all that term with paid up additions, which adds to the base. And then we can see in this column our total death benefit. We can start to see it start to go up from this point on. Now, another thing we want to kind of check out here is how does this compare to the 100% base design? Now, remember, our neighborhood agents or maybe more craftier agent out there is going to may recommend this kind of policy to you, even though it doesn't really grow cash value very well because they're getting that large target premium. So what's the target premium on this? Well, it's also the same as our previous design with the FPR rider. It's coming in at target P. It's coming in at $4,537. And we see this happen all the time. Basically, the lower the target premium, the lower the commission for the agent, the better the policy. Okay. And this has to do with how much of the FPR rider we're incorporating. We can do 1 to 2 blend on this. Okay. So basically, let's also compare our break-even points here. It's one of the things that is very sharply contrasting with 100% base design. We can look at, if we remember correctly, in our first year on the 100% base design, we had no cash value, and we have $6,000 here for the same amount of premium we're putting into the policy. What about our fifth year? We have $44,383 in our cash value, and we go over to 100% base design, and in our fifth year we have $28,500. So considerably less for the same amount of premium, which is why this is kind of more in line with what we want from the infinite banking concept. Now, all that said, this is kind of more of what we call like a base case. So for certain clients, they want that flexibility and being able to contribute to their policy, but they don't always want to contribute the maximum amount. This would be a kind of a good base case measurement, and then they can add in additional premium later if they so choose, as long as they hit those minimums. Okay, but in this case here, this is kind of more in line with infinite banking, although not a totally maximized design. If we want to do a more maximized design, we take a step further and we could do a design like this, which we've done for a couple clients, in which case we're incorporating much more premium towards the APPUA up to that, remember that MEC limit, that 7-pay MEC limit. So the illustrative software here will allow us to put in only a certain amount here. That said, we adjusted the death benefit just a tad to $610,000 to allow us to put in $30,000 a year. We can see the majority of which is going towards the FPR and the APPUA rider. Okay, so when we put in that $24,280 plus the FPR, we can see that just about all of it, $24,892 shows up in the total cash value. Nice other things that we notice is that we burn off that term insurance in the 6th year. So we're making high use of the incorporation of the FPR rider and the APPUA rider by burning off that term insurance faster, which gets our compound interest effect in there faster. Remember, the more premium we can put into the policy in a sooner time frame, the faster and better our policy will continue to grow in cash value over the long run. Okay, the longer we take to put in our money, the smaller the compound interest effect in the policy. Okay, so when do we break even on this policy? Well, for this policy, we break even in our 5th year, which is pretty cool, which is kind of what we want to see. Kind of a 4 to 6 year break even point for Penn Mutual is in the 5th year, where we put in $150,000 in cumulative premium in 5 years, and we have $153,000 plus here in total cash value, and anticipated total cash value. Okay, so this is kind of more in line with the design with a client that wants to put in a considerable amount of money into their policy in the early years. And then as we can see over here, we turn off, which we can do, we can turn off the riders, okay? And then just have kind of like a base policy premium. Okay, so we're maximizing our policy in the early years, and we just carried on with a base contract premium. Okay, so this is just that 34. It looks like 3,500 because we are cutting off that FPR rider. Now we don't necessarily have to continue to keep making this base premium here. We can do what's called a reduce paid up, which is an example in this next page here, where we've paid in for 7 years, and our premium outlay here shows that we have the same amount of total cash value in our 5th year, and on our 8th year we do what's called a reduced paid up. So this is particularly popular with some of our clients that basically just want to shove in as much money as they can in the policy in as efficient manner as they can, and then kind of walk away and not fund it anymore, and just utilize the policy on an as-need basis. Okay, some of our clients don't want to be paying into the policy every year forever, and they don't have to. They can elect for the reduced paid up option here for any whole life policy, and basically it will reduce the death benefit appropriately so that we don't have to make any more premium payments. And this is a more popular design for a lot of our real estate investors. Okay, so that 2 right here denotes that there was a reduced paid up that was made. This is an option. It's up to the client whether they want to continue making this smaller base contract premium, or if they want to elect for a reduced paid up. Either one works fine. By making this smaller contribution towards the base every year, we do grow the death benefit and cash value a tad bit better. So it's really a judgment call up to that client. Okay, so now is our final section here where we're talking about maximizing our policy. Okay, so we had a kind of our base case, putting in close to $10,000 per year through the APPUA rider and being able to increase to 30,000 and at least have that room to do so. But we were kind of limited in the number of years we could do it because we don't want to cause a mech condition. And it would take place, if we were putting in about $30,000 per year, it would take place around the 8th year, even if we cut off the base and the FPR riders. In that situation where some clients do want to be able to contribute over a longer time period, in this case, we would use the EPPUA rider, so the Enhanced Permanent Paid Up Additions rider. Okay, so remember the EPPUA rider, it adds paid up additions outside of what's going on inside this FPR rider. Okay, so kind of slip in paid up additions over the base, but outside of the FPR rider. Okay, so right off the bat, we can see we're putting in the same $30,000 per year, and we're having a similar effect on our cash value here. So we have $24,000 plus in the first year as far as available cash value. And like we do with all these, we break even, looks like the same thing in our 5th year. Now we notice one thing when we compare it to the APPUA, that our cash value is about $151,000 in the 5th year. When we look back here at the APPUA, we had $153,000. So we can see that the burning off of that term faster made this a tad bit more efficient. But if we want that overall long-term performance, we would go with the EPPUA rider, because it allows us to continue to make premiums, in this case, up to the 25th policy year. So we're making $30,000, or at least up to the 65th year of this client. So we're not restricted to the same 7-8 year period like the APPUA rider. Okay, so remember, why are we doing all this? It's not to try to turn whole life into some kind of investment product, which it's not. Okay, this is our infinite bank, right? So like we do with all of our videos here, we find a use case, right? So if you're a real estate investor, maybe we're going to borrow from our total cash value here. Let's say in the 8th year, we have $270,000. We can borrow, say, $100K and put it into a rental, right? we can take that money, put it into a rental, get some cash flow for ourselves, right? So we're nice and happy and we're getting a return as it appreciates. So we got the cash flow, and then over time we get the appreciation factor in the value of the rental unit, so that when we decide to pay ourselves back the 100,000 plus interest, let's say a few years later, let's say, I don't know, the 13th year or so, we're going to have a considerable amount of cash value, which will allow us to continue to grow and grab more properties. Okay. So the use cases are all out there. You know, some of our clients are small business owners. They use this for supply. Some of our clients are farmers. They use this for their equipment and their annual requirements, their expenditures, so that they can produce for that year. And every year they go back to paying back their policy and building their cash value over time so that they can continue expanding irrespective of what's going on inside their business as their capital base keeps growing over time. And policies like this with Penn Mutual allow us to do so in a long period of time. And briefly here, if we jump over to our illustration, we can see here, right here in this section, that the EPPA rider will automatically terminate if we don't make at least the last previous 5 years, at least in this case, $12,274. Well, that's just the total amount over the last few years. So we could literally set up our policy to take in, what is it, $2,400 plus per year in the EPPUA. We don't even have to pay in the full $24,000. We can do basically a tenth of this and still be able to incorporate more in towards our paid up additions without any problems. So we can basically grow into our policy if we so choose. Okay, thank you for watching our video. In today's video, we incorporated the infinite banking concept with our design with the Penn Mutual accumulation whole life product. Okay, we saw how a 100% base policy is a pretty inferior policy design because it does not have good cash value accumulation. We went through the progression of adding the appropriate riders, whether the FPR rider or the FPR rider plus one of the PUA additional riders to increase our cash value and to have better performance over the long run. Remember, the more cash value we put into the policy, the earlier, the better our future anticipated cash value accumulation, as well as our death benefit compared to the 100% base design. Okay, so be on the lookout if you're ever looking at a permanent life insurance policy, whole life policy for maximum cash value accumulation. Please be on the lookout for any kind of inferior designs with 100% base designs. A lot of agents will kind of push those because they get the best commission. Okay, here we try to put our clients in the best situation possible by giving them the most useful and best overall design for cash value and death benefit. Okay, thank you for watching. If you are interested in putting together your own policy to maximize your cash value and grow your assets and give you that tax-free cash value accumulation, feel free to click the link in our description. It'll take you to our webpage where you see much of our information, including a Book Now button. Now, that Book Now button will take you to our scheduling page where you can schedule your free online consultation. As we do with all of our consultations, we'll go over your goals for a policy, what you're looking to accomplish, and fit you with the best carrier and the best policy design we possibly can do. Okay, we also do free policy reviews. So if you have a policy from another agent or another scenario, we'll take a look and see if the pluses and minuses of that policy and if we can possibly do something better for you so that you can maximize your cash value. Okay, thank you for watching. Don't forget, click like and subscribe to the video, ring the bell. okay, to be notified of our future videos that we're putting out here. And I look forward to seeing you on our journey to maximizing our cash value with the foundational asset and grow our net worth. Thank you. See you next time.